Hey everybody, this is Bob, and I have Phil with me for another edition of the Trade Genius podcast. Guys, it's all a scam, all a setup. The big money wants more money, and we have sacrificial lambs here with the banks that went out of business this week. We have more details. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. Okay, Phil, we're getting more and more information now, and this lead-in that they did for collapses is that would have solved the problem. So, but what was really weird to us is that everybody said this bank is fine. So what's up with that?
Yeah, this came out today, right? KPMG, which is the auditing company, they're a big auditing firm. They'll do big banks. Basically gave Signature Bank a clean bill of health just weeks before the collapse. So here's a little more detail on that they 14 days after KPMG LLP gave them a clean bill of health. Pretty wild, right? I mean, these guys come in, it makes you think, what the heck is going on? We hear things that Silicon Valley Bank was exempt from the bank stress tests that were going on, which means that they can come back and tell us how great the banking system is doing. It just, Bob, I just get the feeling that there's more to this than meets the eye. And I mean, it's very, very odd to me. This one really threw me for a loop when this came out today, that they come out of the audit, 14 days, 11 days later, whatever it was, and fail. That's just wild stuff. That's not anywhere near how any of this is supposed to work.
Yeah, and look, you're starting to get the reverb back that this is Trump's fault because they weakened Dodd-Frank. That's a bunch of baloney. First of all, Democrats were just as enthusiastic as Trump was to lighten that burden on the banks, but Silicon Valley Bank specifically was at the 50 billion asset threshold, and they fought like heck, and they engaged Yellen to not be put into that big bank or too big to fail bank category, which would have required them to keep even additional protections or assets or more liquid assets on their books. And so she has her fingers dirty on this too. And everybody knows why, right? I was watching a TV show with an NBC reporter, and they call this the Democrat ATM bank, meaning this is where they tap into for all their financial support for their campaign. So, you have a lot of people looking hard at this bank. And if they would have had to have taken a stress test, Phil, they would have had to do a rewrite of their earnings last year. And, that would have been just as devastating then as it is to them now. The other thing, too, that people don't realize is that they borrowed nothing from the Federal Home Loan Bank. And next thing you know it, they're borrowing heavily from this bank. That is a red flag. When you have banks that start to borrow heavily from this institution, that's alarm bells, because that's happened before. And you would think it'd be algorithms or AI or machine learning or somebody that's not watching, porn instead of doing their work during the day to see that, hey, this is a problem here with the bank. Now, they may have done so and it went up the chain of command and it got kiboshed. We'll find all this out later here, but this is a big problem, and that's why you can never trust the regulators. So the regulators failed in this situation. The other people too on this is that there were VCs that wanted this to happen, okay? JP Morgan was in there begging people to flip their accounts over to JP Morgan. So there's a lot of people that really, really want this bank to fail because it serves a lot of agendas. The big banks get more control. The government gets to come in and quote unquote help. If now they forced the Fed into this situation where today they just announced, Phil, they're backstopping everything. That's $17.6 trillion. You know what that would do to inflation if they had to start increasing the money supply to cover everybody and their brother that wants to pull their money out of the bank? bank, and they can't even print enough currency. So if people say, I want my money, I don't want you to transfer it somewhere else, right? That's a problem. Or the government says, "Hey, if I can force more people into T-bills, right, then I can serve the purpose of $17.6 trillion into the federal government to pay their bills because what they're rolling over now, Phil, what, $20 trillion in debt here over the next 3 years. So there's a lot of agendas here. It had nothing to do with this bank. What they did this week to protect the other banks would have protected Signature Bank, would have protected SVP Bank. And so this is rife with agendas. And you're hearing China has a stake in this, maybe. You're hearing about the WEFs in on this thing. So instead of clarifying things for people, they just created a whole new series of finger pointing. And inside the VC community itself, Phil, there are some really hot people right now because San Francisco, the Bay Area, really wanted to become the financial innovation center of the world. Well, the New York banks just kiboshed that whole fantasy too. There's no major bank now that has that, I would say, that soft heart for a startup. Now those guys have got to go hat in hand into New York, and they're not going to get cut the same kind of deals where everybody knows each other. This isn't the bar at Friends now anymore. So really interesting stuff. And guys, it changes nothing. The Brits had a problem with their bonds too at one point, and they went ahead and they just kept on raising rates, Phil. Remember that? And solved the problem and kept raising rates. So I'm going to back off now. I think, we have issues here instead in front of us. You want to show the market and show Bitcoin, the market didn't necessarily embrace this thing totally, even with the CPI print coming out kind of benign today.
Yeah, and the other thing I would say too is that these banks were crypto friendly too. And like we were chatting before the video, that to me it sure seems like that legacy banking kind of missed the boat on crypto. They certainly missed the boat on Bitcoin because most of Bitcoin's been mined and is being hodled away. But what they could do is get their arms around crypto. I think they look at something like what happened with FTX and they look at how fast those guys made billions of dollars. Granted, they blew it all out of sheer negligence, but at the end of the day, they had a pretty decent bankroll that they built up in a very short amount of time. So I think Legacy's looking at crypto as, man, this is ripe for the harvesting. And I think that when we see, like why didn't they shut down Silvergate? Oh, that's right. Citadel and those guys went diving in there. So it tells me that the bankers do want to get in on the crypto action, but they want it on their terms and they want all the revenue to themselves. So I think this also, on top of the points that you've made, I think crypto and banking crypto is part of it too. And they're trying to get these guys outside the club, cut off, bring it in. And I wouldn't be surprised, honestly, Bob, if we were trading same products that were on FTX down in the Bahamas, if we were trading those same products come this next halving run. But this time, the legacy banks, the legacy brokers are making the profits and not an outside company like FTX. So that being said, let's go check out some charts. Okay, first up, you guys asked, is Bitcoin decoupling? That's like the number one question right now. And I would say, boy, that sure seemed to be the case because we just went straight vertical after coming up. But I'm going to show you guys something here that kind of makes things a little more sensible. We came down through, and there was a number of moving averages, the 200 daily. This is the 144. I kind of like it because it's a little different. But we came right down to it, and then we bounced. Now, was I expecting to get an immediate, nearly $7,000 bounce off of this? No. But with the banking panic exit, the USDC panic exit, I think it exasperated things. It also tells you how fast Bitcoin can move when there is demand. So that's something to keep in mind going forward into the next cycle. That being said, this is a moving average we touched on in a previous video. And again, this is just technical analysis. This moving average 377 EMA on the daily. This moving average to me is like where you start drawing the line as far as is the bear market over and we start going into the new bull market, the new halving cycle bull. So what you don't want to see is what's happening here right now. And the day's not done. 8 p.m. Eastern, I think, is the new daily candle with daylight savings time. However, if we get a daily close under this, notice what happened. We had all these little highs back here on the earlier in February that marked off that 25K psychological level, and we failed. Usually when you leave a series of highs within proximity of each other, they're ripe for the taking. But What you don't want to see is them get popped and then this comes back in and closes under this level. Some people will call that a swing failure. It's a bearish especially when you come off this setup, it's bearish. So let's just say the day ends like this candle, and we won't know until after this video is published. We can talk about it tomorrow, but this is a bearish setup. And basically now this 25 to let's say 25.5 area is where you're going to want to see a potential defense. And then if they knock it back down significantly tomorrow, this could be a giant bull trap. And especially if there's a bad reaction off PPI tomorrow, which is our other high impact news item for the week before the FOMC meeting next week, we could see a significant trap here and pullback. And if this truly isn't a decoupling, but was just kind of panic exit on USDC, this could snap back down relatively quickly, because at the end of the day, I still haven't seen enough to tell me that Bitcoin is truly decoupled from these markets. So if that's the case, Bitcoin snaps back down and kind of recouples with S&P 500. Not my favorite outcome, but you got to be realistic about it. All right, the stock market. ES. So ES is the futures for the S&P 500. As you can see, we're trending back down. We came back up, poked our head over the weekly 50 SMA, fell back down. I think given the price action, and you'll notice like before we came down to the weekly 200 here, okay, we came down to it. That provided our big bounce out of Q4 and we came all the way back up here. I think we're going to retest it because I think that's what the market's telling us. The market structure is broken down. We've made a lower low and a lower high. And right now we're in this area. You can see where we're consolidating, and how we break down out of this usually will give you enough juice once this is consolidated enough to give you a breakout move. And if we start trending back down and we start probing these lows, this weekly 200 is not that far away. I think the bears short term are still in control under this daily 9 EMA. We kind of like to look at that as a reference point for trending down. And, today we had that announcement. And that's the other thing too, Bob. All these little announcement pumps that we've been getting all get retraced sometimes into the same day. So none of these little pump efforts are actually pushing us out of this zone. They're all getting smacked back down. You see, like this is the third time now they've tried to push out of this and smack back down. Now, I'm open to this, whichever way this breaks out. But right now at this point in time, we're just kind of chopping in here, and we still have tomorrow to resolve. And then we got OPEX on Friday. So a lot can happen. I expect volatility to be sky high in the interim.
Yeah, I mean, and oil's in a range, and the only thing that's interesting to me is that there seems to be a little bit stronger bid here with gold and silver, so we'll see if that that maintains still. But you're right. Look, guys, we have unfinished business down. And when they pause and pivot, that's when you actually get the most bearish. It's not like, oh, happy times are here again. Right. The only reason why they're doing that is that deflation is coming, and when you have deflation, companies lose pricing power.
Yep.
So so just watch. You'll see videos on that from us. The ideal scenario for us would have been we should have had a flush here, get this market down to between 3,200 and 3,600. Clear out some dead wood here, more thoughtful response to the banking crisis, and then we probably could have lifted out of there for at least 3 or 4 months. Now we're just going to be trapped in this cycle of news and rumor and fear, and the market's going to be gyrating. And trust me, you don't want it. Phil and I don't care because we trade, but you'll care desperately about your portfolio because you'll question your existence when these moves start going like this, and you're going to get scared and you're going to bail out. Yep. And you probably bail out at the worst possible time. Yep. And so they really messed us up here. So we're going to have to see what Powell says here next Wednesday, but it's not going to be fun, Phil.
No, I agree. And look, this is the environment where here we just ripped off the lows into the last hour. We've ripped 50 points straight up in the air. These are not normal functioning markets right now. They're very illiquid, very prone to news. This drop here was when the Russian jet ran into the Reaper drone in the Black Sea a little after noon today Eastern. They retrace it. It's just a lot of volatility right now. And we're just, like I said, bigger picture, we're holding into this range, but this kind of stuff is really I know it's a lot of points, but it's really just noise in this area until we can resolve out of here, which you guys can see on the higher time frames, this chop zone. And that's what this market does a lot of times. It gets into these areas of severe chop, and really what happens coming out of that chop is where the bigger move comes from, and then you get some trending days. And then this is what hardest part about day trading is these zones here. So, but you get them. You move, you chop, you move, you chop. When you understand the architecture of how the market moves, it makes more sense, and then you can better trade it. But yeah, I agree with Bob. Bigger picture is down.
All right, guys. Hey, thanks for listening. Hit like, hit subscribe, notification bell, get the notification. You can catch all our shows and, check out our newsletter, check out our service, tradegenius.co. We really appreciate the views. They're starting to go up. Tell your friends and tell us what content you want to hear and see. This is your show as much as ours. So let us know what things really interest you so that we can help you navigate these markets more effectively. Thanks for listening.
See you guys.
Trade Genius.